Okay, well, thank you very much to the organizers for putting our paper on the program here. I learned a lot. You'll see a lot of the things I talk about are very related to things we already talked about today. But the first thing I need to say is this is joint with Ding Ding, Shang Feng, and Brian Hardy. Brian Hardy is at the Bank of International Settlements, so the usual disclaimer applies. So let me talk a little bit about the motivation for this paper. And really it goes back to a paper that Brian and Chung and I wrote, that came out last year. And the title of the paper is Who Holds Sovereign Debt and Why It Matters. And one of the points of this was to say, and we saw this in the first session today, is we know that government debt in particular, but debt in general, has increased significantly since COVID. I was really happy that Joao Gomez had this nice slide and presentation about it, so I didn't have to motivate. You can see that that's not just a US event. That is something we see globally. Around the world, debt has increased. And the point of that paper was, well, it wasn't the point, but one of the things we discovered is that if we break down who is holding that debt, it turns out that so-called non-bank financial intermediaries are the ones that are the most elastic or most likely to sort of go in and out of these debt markets. And the most, and in fact, we found that, as an example, emerging markets, a 10% increase in debt by sovereign borrowers would lead to something like a 6% increase in the cost of borrowing. But if these investors, these non-bank investors, were not present because they're so elastic, it would increase it to something like 8.5%. So that's just sort of an example of why that's important. Now, breaking down who these non-bank intermediaries are, the most price elastic are investment funds, such as mutual funds. I'll come back to that in a minute. And sort of second, I would put there, it turns out, are pensions and insurance companies. That's kind of part of that. So sort of a question then is, how important is this on the borrowing side? And this has also been echoed by others in the literature, including Zhu had a paper last year, or 2 years ago, basically arguing that pensions provide sort of stable hands, if you will, in these debt markets because they are going to be sort of less sensitive to this investment runs. Okay, so this is a little bit of the motivation. So in this paper, because we now have the opportunity, we can look a little bit more specifically at pensions because we know they are important. And so what we do to kind of address this question, although I will come back to the borrowing question at the end, what we do is, first of all, we put together a data set of global pension funds and their holdings. We saw a lot of that today. And in fact, what we do then is we study sort of the general trends and allocations. And this is going to look pretty familiar from what Jim said earlier. I sort of said, you stole my thunder. But we're going to look at this in terms of globally. Essentially, we find, not just in the US, but in a lot of different cuts of the data, a declining share of allocations to fixed income. Okay, does that sound familiar, again, from today? And at the same time, an increasing share to equities, mutual funds, alternatives. Okay, we saw that today as well. And then what we do is we analyze then what is the effect of interest rates. Again, I don't have to motivate this because we talked about this today, but here we find essentially that the debt holdings are, as you might think, are increasing with government yields, and other assets or allocations correspondingly decline when interest rates increase. Okay, since I have a short amount of time, I won't do a long literature review, and now I know that there are more papers I need to put in the literature review after today. But just briefly, we're not the first to look at this shift, and so it ties to that literature. Also, reasons why there might be such a shift. Again, we talked about this today. links to fund-of-fund retirement structures. And then the thing that our former paper really ties into is what are the effects of different types of investors in the market. Okay, so let me start first of all with real quickly about the data. Okay, so what you're going to see some trends, and I just want to say where these data come from. For global patterns across countries, we're going to use the OECD global pension statistics. And so this is going to be portfolios for 87 different countries over time. It's going to be a panel. There are some limitations. So the nice thing, of course, it's a lot of countries, but the limitations are that it does mean that when we look at things like bills and bonds, it's going to be all fixed income. Okay, so I'll say a little bit more about decomposing the government debt part of that in a minute, but that's, keep that in mind. The other thing is for U.S. pension funds, we're going to use the financial accounts of the U.S., Z1 in particular, the public plans database, PPD, and that's to give us some sense of the participation in these alternative investments. For global patterns on the investor side, Preqin, and then the government bond yield data from FinOne. Okay, so let's look at this. First of all, this part really does echo Jim's talk. First of all, if we look at the trends from fixed income to mutual funds, this is the U.S. for the moment. The blue line here is showing mutual fund shares, okay? Whereas the red line is showing bills and bonds. This doesn't work, right? I just realized. Okay, so this is the blue line is showing an increase in mutual funds, and then you see the red line showing that decline. Equity a little mixed here. Okay, now if we look at advanced Europe, we do have emerging markets. I'll say something about that in a minute. But for the moment, this is advanced economies in Europe. This trend is pretty striking, right? You see this red decline. You see the blue increasing. So you see that there is just this shift, essentially, from holding things in terms of fixed income, in terms of directly bills and bonds, and into these mutual funds. Okay, in the interest of time, I'm going to skip the emerging markets, but it turns out if we look at the emerging markets pension funds, they have a very similar pattern. Okay, so you might say, that almost looks mechanical, right? And so what do we know about mutual funds? Well, we know mutual funds invest in lots of stuff, right? And they invest themselves in bills and bonds, right? They themselves invest in fixed income, as well as equities. Okay, so can we do some see through, what am I trying to say? Can we look under the hood, right, to find out, are they implicitly holding more fixed income through the mutual funds? For the whole global database, we can't, but for some important segments of it, we can. So for advanced Europe, we did that analysis. So what you're seeing here in blue is basically what I showed you before. This is the share of assets and pension funds, and you see the blue decline. But if I add on top of that how much is being held implicitly through mutual funds, you can see that's also declining. Okay, so this decline in fixed income is true whether we're looking directly at fixed income or we're looking at it through mutual funds, okay? And I guess I heard from my co-author today, I asked her how many countries can we do this specifically for? She said, there are 12 countries, but we can't say anything about the rest of the world, okay? So there are 12 additional countries, including some emerging markets such as Chile and so forth. Okay, as I said before, this is looking at everything. This is looking at all fixed income. So it's a pretty big bucket. Can we say more about fixed income versus, government debt, which had been, as I said in the beginning, our interest? So this is, we can't do it, again, for everybody, but the U.S. in particular, we can. So what you see here is, of course, both public debt and also private debt are declining, the biggest swing, of course, is with public debt, i.e. essentially treasuries. Okay? So I guess one thing to keep in mind here is that although for all of it, the global we can't decompose, we can sort of see a sense that yes, indeed, holdings, again, this is echoing what Jim said, but holdings of fixed income are declining. Okay, so where are they moving into? We know they're moving into mutual funds, and there's the mutual funds for, we know that it's increasing in mutual fund equities. It's also increasing other equities. But we also know that there's been an increase in holdings of alternative assets. Again, this was echoed earlier today. For here, I'm looking at U.S. state and local pensions. Okay, so you see this pretty clearly, an increase in private equity holdings, an increase in real estate, hedge funds, and sort of other things. Okay. Now, is that just the U.S.? Again, we can't say look at the whole world, but we can look at some of the other parts of the world. So this is looking at, this is again a comparison of U.S., but we have Canada was mentioned earlier, the Europe Advanced, UK, Switzerland, Australia. The scale's a little different because this is now dollar amounts. But if we blow it up, that's another slide, it's on the paper. But essentially, you'll see for all of these, there's been an increase in private equity and in some cases for private credit as well. Okay, so bottom line here, this is not just a US phenomenon, we're seeing this kind of globally. Okay, so then the question that we had, because this was sort of front and center in our earlier paper, was, well, there's a lot of questions, right? One is why. But one is also, how does this connect to interest rates? So one way that we did this is we said, okay, we know that pensions are typically going to be, and we saw, again, heard this today, but it's going to relate to long-term rates. And so we took our panel of the 87 countries, this is starting in 1980, and we regressed then the portfolio shares on the yield, and also there's a fixed effect for the individual country. So here in this, I is the country. So it's in plain language, this is just the share of the pension fund's allocation for a given country on the yield. Okay. So here's just a quick look at what it looks like, and I think it goes the way you would think. So if there's an increase in the interest rate, a 1% increase in interest rate, the share in bonds goes up. That's the one. It decreases in equity. In mutual fund shares, it also decreases and also decreases in foreign assets. Okay, so it's splitting the way you would think, and also what you kind of saw in those graphs. Now, we talk more about this in the paper, and I don't have to motivate defined benefits versus defined contribution to this audience. But so what we do here, though, is we say, okay, we were looking at all pensions. If we split them, which ones are really being driven by interest rates? So for that, what we did is we did the split by country on whether they had, what their allocations were to defined benefit and defined contribution. It turns out, this is something else I learned, some of you may know this already, that different countries have different levels of defined benefit and what's guaranteed, and also defined contribution. Even defined contribution plans can also have different guarantees. I won't go into that in the interest of time, but these are what are called types in the data set. So there are different types of these. So what we do then is look at the share in terms of type, and we also break out defined benefit versus defined contribution. So what do we find here? I think this is also intuitive. So the top line is telling us, if I look at defined benefits, this one is really the one where the action is. They're the ones when the interest rate increases, there's an increase in allocation to bonds, a decline in mutual shares, and also foreign assets. But if I look at the same thing with defined contributions, it's kind of insignificant. There's, it does increase a bit, but you can see this is not significant. The real effect is less allocation to foreign assets. Okay, now we also know that advanced economies are different than emerging markets. So the other sort of split that we did was to say, what about pensions in advanced economies versus emerging markets? And I think here you can see pretty clearly, so this is the emerging markets line, that's the advanced economy line. You can see here that, yeah, it increases both, for both, but really the biggest, strongest effect is with emerging markets, which I think is consistent with thinking about this is where the debt is riskier and so forth, so there's a stronger effect. And the other categories, you can see the other allocations to other parts of the portfolio are declining. Okay, so sort of what do we take from this? Well, as we said before, we see that this trend that we've talked about today is something we see globally. Pensions are moving away from fixed income globally. And this also, now if we look at things more in terms of the vulnerability of the market itself, this does mean there's more movement into riskier assets. And so since pensions are traditionally viewed as a sort of stabilizer, it does raise the question of, is that going to be true in the future? Or are we going to see then that they are now going to be less willing to kind of step in, if you will, and be the ones to provide more liquidity in the market? Okay, so I can't tell if I'm out of time or over by 2 minutes. I think I'm out of time. Okay, thank you.